Planning. Let me introduce you to today's speaker, Mr. Mukul Jain. Mr. Mukul Jain is a qualified engineer and he has an associateship with III, both in life and general insurance. He has various other qualifications like PGDBA from IMA, and his latest assignment was with SBI Life as a training head.
Good day, participants. So today we are starting a session on insurance and risk. We'll be studying about the insurance concept. We'll be studying about the principles of insurance. We'll be studying about the working of insurance, how the insurance works. So by the end of this session, we would have a fairly good idea about how insurance works, what are the various nuances of insurance. So as you know, as you have studied in the first chapter about risk management, that risk is a situation where there is a possibility of an adverse result flowing out of an occurrence. So there can be two possibilities: either there would be a loss or there would be no loss. Then there were various classification of risks. Basically, there are various ways by which we can classify the risk, but basically we can classify the risk into two forms. One is risk. We can classify into two forms. One is pure risk and the other is speculative risk. Now, pure risk, what is a pure risk? Pure risk is a situation where a risk can happen, that is, a financial loss can happen. Basically, we are concerned about, in insurance, we are concerned about financial losses. So, we would confine our discussions to financial losses only, financial or economic loss or pecuniary loss as we call it. So, in pure risk, there can be two situations. One situation can be of loss. Loss could be due to various perils like natural calamities, due to fire, due to some accidents, due to collisions, due to dishonesty or fraud by another person. So there could be a financial loss by many reasons. So one situation could be a financial loss. Another condition, no loss. That is a status quo. We are what we are in that state in which we have always been in that state. For example, a person's car is stolen. A person's car meets with an accident, with a collision. So therefore, he is now in a position of loss. Now he has to incur loss. Otherwise, he would not have to incur that loss. So he was in this situation. So everybody wants to be in this situation of status quo. So therefore, this is a situation which comes under the domain area of insurance. Now let us see what is speculative risk. Speculation as a word, as a dictionary word, we see speculation. We hear this word every day in various business news channels. Speculation, this shares is more speculative, shared business is speculative, gambling is speculative. So speculative is basically, according to economics and according to risk management, speculative risk is that situation where there can be two possibilities. One possibility is that there can be a loss, but the second possibility is that there can be a profit or a gain. We can say there might be a third possibility also, where we can say neither profit nor gain. So there can be a third possibility also. Basically, if you see the various businesses, commercial businesses, they also operate on speculation. But that is a calculated speculation. That is a calculated risk. Entrepreneurship is a calculated risk. This is what we have been studying since so many years. But gambling is a wild risk. It's a wild speculation. So therefore, the level of speculation the degree of speculation may differ from one business or one occupation to another occupation. But there are three possibilities. In some businesses, they achieve what you call a break-even point. That is a position of neither loss nor profits. So profit and loss. Basically, the speculative risk doesn't come under the domain area of insurance, because insurance has no mechanism to. Insurance does have a mechanism to compensate for the losses, but it doesn't have any mechanism to operate in this area. What if a person makes a profit? Will the person give something extra to the insurer? So it doesn't come under the domain area of insurance. So insurance is confined to pure risks. And we also can't say that all the pure risks are insurable. Then also it has to see that which of those pure risks can be insured, which of them cannot be insured. So for that, we'll have to understand what is the theory of insurance. So insurance basically, when we talk about risk management, in the last class also we had talked that insurance is a mechanism of transfer of risk. There are various ways in which you can handle the risk. Number one, we had studied the other day that the risk can be avoided. For example, I hear that yes, there are landslide in certain areas. I don't venture in that area. I don't go. So I've avoided that risk for myself in a simple layman's language. So that is a situation of risk avoidance. Sometimes in industries also, industries doesn't have to install a particular equipment in which is more prone to risk, which is more prone to some leakage of gases and all. So they may decide to install another equipment instead. So that situation can arise technically also, avoidance of risk. Second way of managing risk is that risk can be retained. Okay, I retain my risk. I may lose my pen. I may lose it, but there is no point in insuring it. I will end up in paying more premiums than what claim I would get. So in turn, I decide to retain this kind of risk. In large industries also, in our economic scenario also, there are many organizations who have to decide that yes, these are the risks based on the severity, based on the frequency. Sometimes the frequency of loss may be more, but the severity is very low. Severity of, for example, we lose pens every now and then, but the severity is very low. We can bear those kind of risks. It doesn't place a person into an economic loss, into a financial loss, something like that, into a kind of bankruptcy, we say, or it puts the person quite back in his in the path of his progress. So therefore, those kind of risks are insured. So we don't retain those risks. Those risks are transferred. So that is the third strategy of managing the risk. Risks are transferred. So insurance, we are transferring our risk to the insurance company. So insurance is a business. They are transferring the risk, in turn they are taking the money. They are taking premiums. There are other strategies also that risk can be reduced, then risk can be shared. There are further strategies to it. Risk can be shared is a concept called co-insurance, which we would be studying in the course of our sessions later on. And then risk can further be reduced or that is another strategy which is called reinsurance, co-insurance and reinsurance, which we will be studying later on in our later sessions. So coming back to insurance. So insurance is the mechanism of transfer of risk. Transfer of, you can say, pure risk. Then there is another word associated with insurance, that is uncertainty. Now it is said that insurance converts uncertain events into certain events. Basically, for a person, for an individual, it is basically converting his uncertainty into a certainty. That yes, in case the loss happens, I will get this much of compensation. So, but it gives it gives a person a peace of mind. It gives a person a sense of satisfaction that yes, he doesn't have to be a bankrupt or he doesn't have to be a pauper if a big loss happens to him or her. So therefore, uncertain, but the event should be uncertain. So it is said that it's the old saying that no uncertainty, then no insurance. That means insurance will not operate in that area. That is, the event should be uncertain. If we are sure that a particular loss is going to happen, then the insurance company is not going to transfer that risk on it. If it's sure that a person is in a critical unit, if a person is in ICU, and a person is literally on his deathbed, will the insurance company insure this person? No, they will flatly refuse it because the end or the loss seems inevitable in this case. Similarly, if a building is in a dilapidated condition, so will the insurance company insure that building? No. The heavy rains are lashing all over the city and the building is already in doldrums, so they won't. They have to assess the physical condition of the asset, they have to assess other technical factors. So therefore, the event should have uncertainty associated with it. Now, how does insurance work? For example, it is said that insurance are based on what we call aleatory contracts. Basically, there are two kinds of contracts. one contract is, aleatory is just the opposite of commutative contracts. Commutative contracts are those contracts in which we receive a product or a service commensurate to the value which we are paying. For example, I am paying 10,000 rupees to buy a television set. So I am paying a commensurate value. If I am buying a Sony television, it is having a different cost. If I am buying a local model, it's having a different cost. But I know that what is the quality associated with it, what is the brand value associated with that. So I am paying a commensurate cost. Whereas, so those are known as commutative contract. That is on the same level. The two parties are paying or receiving on the money or benefits on the same level. Whereas aleatory contracts, that one party pays much less than what he will receive. So like insurance, we pay a small amount which is known as a premium. Premium is the cost of getting the coverage, getting the risk coverage, getting our risks covered, converting our uncertainty into certainty. So we pay a small cost, and in turn we hope to receive a large sum, which is known as the sum assured or the sum insured. In the case of life insurance, we call it sum assured. In the case of like general insurance, we call it sum insured. So, but then it's not sure in these cases that he will receive this amount. He or she, the insured person, will receive this amount only on the happening of that particular event. So a kind of conditional. So these contracts are also conditional. They are aleatory because one party may receive more benefit than what he is paying. Then at the same time, they are also conditional. Number one, it depends on that event. If that event will not happen, he will not get anything. Number two, they are also based on the condition that till insured is paying the premium, then only he will be covered. Then only he will be paid the sum of money. In case of life insurance, because the life insurance are long-term contracts, in case the insured stops paying the premium, the contract will not be in the same shape and same terms and conditions. So he may not receive anything, or he may receive a very reduced amount. So sometimes there has been a debate all over the world about insurance. People say, well, insurance is like gambling. That means you pay a small amount of money and you receive a large amount of money, and it is based on chance. If that event happens, then you will receive a large amount of money. So it's another form of gambling. Now, what do you say? Whether we call it a gambling, what is the difference between a gambling and insurance? Probably, if we understand the difference between gambling and insurance, then we would be able to understand the concept of insurance in a much better way. See, gambling, what happens? Gambling, we bet. Betting is also a kind of gambling. We put our money on horse race, or we play cards. Some people play chess. In our old mythology, also in Mahabharata, we have incidents of gambling, wherein you have found that Pandavas lost everything, their kingdom and even their wife in gambling. So they put at stake all of their possessions. Basically, what happens in gambling, before a person has ventured into a gambling act, the risk was not existing for that person. Only when a person has decided to play cards with money, he is plunging himself into that risk situation. So risk did existed before. Had he not gambled, there was no risk for him. So there is a risk in gambling. So he has created a risk for himself. Whereas in insurance, a person has not created a risk for himself. Risk already exists. In the case of insurance, risk exists with us every day. If we are driving on the roads, the risk is there. We are not creating risk. We have to go, we have to commute. So that is a part of our life. We are living in a house. So we are not creating a risk. The roof may fall down. So it has to be, the event has to be fortuitous. Fortuitous means it has to be sudden. It cannot be anticipated. It has to be it has to be unforeseen. We cannot foresee. If we could have foreseen it, then insurance would not have insured it. Insurance company would not have insured it. So it's a fortuitous events. We didn't know what's going to happen next. For example, earthquake comes. For example, flood are coming nowadays in Maharashtra and Odisha and other parts of the country. So they had not foreseen. Today there is a heavy rain lashing all over Mumbai. So once again, the people are remembering the incident of 2 years back. So therefore, in insurance, the risk already exists. And what happens in gambling? One person gains at the cost of others. For example, you saw in Mahabharata, Kauravas gained at the cost of Pandavas. So one person has to lose his everything in order to provide gain for the other. Whereas in insurance, this is not the case. A large number of people provide compensation to those who may incur losses. So it's not a total loss to one person, one individual. So basically, insurance works on a concept which is known as sharing of losses. Basically, this is also a concept of sharing of risks. For that, I'll tell you a short story to understand how insurance works. It works on sharing of losses, but let's understand a story. I'll take you to a imaginary story from which we will try to extract the basic nuances of insurance. There was a village. There was a village in India, and it was having a population of 5,000 people. Let us assume that out of these 5,000 people, there were 1,000 persons who were the earning members of their family. I am taking an average, for example, a family is of 5 people. So one person who was an earning member of the family. So 1,000 people were the earning members of the family. Now one day a statistics was told to them that out of these earning people, around 5 of them die every year. So this is the statistics of 25 years. Last 25 years statistics reveal that out of these earning adults, around 5 people die every year. Now this rang the warning bells in the minds of all these earning members. So they called a meeting, they held a congregation, and they said, one of the leaders among these people said, well brothers, the statistics says that 5 among us are going to die for the next in the next coming years also, because this is what the past 20-25 years statistics tell us. So if 5 people die, then we are seeing that whosoever earning member dies in a family, the family has to undergo all sorts of trouble or sorts of hardships. So how to mitigate these hardships and trouble? So had that family member some amount of money, then they would have lived their life for a few years, so till the children are able to stand on their own feet. So they said, some of the leaders among this group said, okay, how much money do you think that one person's family need according to this village standard? They said, okay, everybody agreed on 50,000 rupees should be given to such a deceased member's family. So they said, see, the risk is equal on all the 1,000 people. We don't know who those 5 people would be. So that means if we consider this statistic, so we need 1, 2, 3, 4, 2,50,000 rupees per year. So what we do? We divide it among 1,000 people. So this is 250 rupees per head. So we may create a pool of funds, and everybody, assuming that everybody is participating in this pool of funds, so everybody would put 250 rupees each. So that means there are 2.5 lakh rupees in this fund. So at the end of the year, if these statistics are true, we will give 50,000 rupees each to those 5 people. So this is how the insurance works. This is how insurance companies also work. But then the concept is, this is the basic concept, but it's not simple. Had it been simple, then we would have provided insurance among our localities on the basis of towns and on city-wise, village-wise. But it's not easy. There are so many technicalities associated with it. What happens if 50 people die? From where the rest of the money will come? All of them will demand, we had paid 250 rupees, give us 50,000 rupees. What if only one person dies? then 2 lakh would be left. What will they do about from that 2 lakh rupees, which will be left in the fund? What happens if all the 1,000 people die? For example, there is such a catastrophic loss. So all these answers are, you would be left wondering with these answers. So insurance concept. So we need professional companies called insurance companies who can manage these funds. Those who have that fund in their pockets, because if they are insuring 1,000 people and they are assuring them that on your death we will pay you 50,000, so they should have this much fund in their kitty. 1, 2, 3, 1, 2, 3, 4. So this is 5 crores. So unless and until a person has got 5 crores in his kitty, he cannot assure people that I will give you 50,000. So that means there is a need of some capital also before starting a venture. So this is all for today. You are invited for questions. We will talk about the principles and other basics of insurance in our later sessions. Thank you.
Sir, I have one question.
Please.
Sir, is risk assessment a one-time process where one should do a risk assessment just before taking an insurance policy, or is it a continuous process where one should do proper risk assessment after a regular interval of time?
Well, risk assessment is a continuous process. In earlier days, we used to think that there was a general notion that risk assessment is a continuous process only with large corporations, with large industries, not with individuals. An individual had taken an insurance one time, so his or her answer would be to an insurance salesperson, I already have an insurance. But no more. This theory is true because a person also moves through his or her life cycle. Once a person is adolescent, then he is a young adult, then single adult, then becomes married. So needs go on changing. Your assets also keep on increasing or decreasing, whatever the case may be. And so there is always a need for assessment for the risk.
So can you tell me, gambling and insurance, both of them are two different categories. But then there are still few activities under gambling which are being insured by people or by life insurance companies. Is it actually happening or is it correct? If it's happening.
Could you give some examples? Which are those activities which you call as gambling and they are being insured by the insurance companies?
Probably there are few games which are played. They are people invest into them as part of gamble, but then they are being insured under the acts. Like you can take an example of a live match which will be telecasted, and then people are actually placing a bet on them. So certain activities.
The game as such, a game of cricket, if you are talking about a game of football, it's not a gamble. The people who are doing the betting on it, it's unauthorized. It's not legalized by any law of the land, whether it's India or whether it's Pakistan or whether it's Australia. So it's a unscrupulous activity, and definitely we hear news that people and the police catch hold of them, these people. So it's not legalized in any country.
Sir, I have a question. Sir, there was an article in the newspaper where a company was offering insurance to those people who got caught in the train without tickets. They are ready to pay the ticket amount if they will caught by the ticket checker. Is it ethical for on their part?
No, well, we have not heard of any of these kind of policy. What kind of policy we have heard is about that passengers, they travel from one place to another place. They get in, so whether it's transport corporation, roadways or the railways, they have tie-ups with insurance companies so that they include a small amount of premium in their ticket, so that if there is any accident due to any cause, so instead of the state government paying compensation to the victims, so the compensation comes from the insurance company. Last year there was an arrangement of an insurance company with Rajasthan Roadways. So the premium depended on the distance. If one is traveling between Jhunjhunu and Jaipur, so the distance would be something else. If somebody is traveling between Pilani to Udaipur, the distance would be long. So accordingly, the percentage would be charged on the ticket rate. So those kind of insurances are there. But ticketless travel cannot be a matter for insurance because it's not a legalized thing. Yes.
So there is a question, there is a point in insurance like micro insurance. What is it?
Well, micro insurance is a new concept in India, and there has been a lot of talk about it. It's basically a it's part of the social obligation of the government, and in turn it also becomes the social obligation of the insurance companies. Basically, micro insurance is when the benefits of insurance have to percolate down to the lowest denominator of the nation or the society, the poor people, the people who are landless, laborers, farmers, daily wagers, who cannot otherwise afford to take an insurance plan because they have to go through all sorts of hardship to make their both ends meet. How can they afford to pay premiums? So therefore, it's the government's endeavor to promote this kind of insurance, micro insurance, so that the insurance benefits are also given to those kind of people through banks, through cooperative agencies, through NGOs, and in turn, insurance companies also find big potential to sell their products because after some time, the urban markets or the so-called haves market would saturate, and then they will have to go to this have-nots market in order to sell insurance benefits to them. So it would be a kind of selling a mass insurance programs, maybe in a group insurance scheme, farmers who have taken loan on fertilizers, on tractors, on implements, etc., etc. Rickshaw pullers, all sorts of laborers. So that this insurance benefit can be given to them. So micro insurance is coming in a big way all over the world, including India.
So in the concept of insurance planning, while we are talking about the planning structures and all that, laws and regulations are already being given out. We know what the concept is, insurable interest is it's supposed to be present out in there, proximate cause is going to be there. So what is the case about insurance planning? Is the thing of investment coming out into the insurance? If the thing of investment is coming out, we know we cannot make a profit out of insurance. So what's the case of insurance planning into that?
You mean profits for the insurance companies?
I'm talking about if the person is investing into insurance is nowadays seen up as an investment procedure.
Right.
So, but talking about insurance concept, the case is we cannot make profits out of insurance. So, is this concept okay, or otherwise we are changing out?
No, see, insurance is basically many people confine their discussions to life insurance when they are talking about insurance. Insurance is life as well as non-life insurance. So if we are talking about investments, so investments we can think of in life insurance only because life insurance is a long-term contract. And basically, if life insurance is basically term insurance, if you consider life insurance also, that is term insurance, you pay the premium and forget about it. If death occurs within that term, then the sum assured would be given. If death doesn't occur, then nothing would be given. This is what the insurance concept, basic concept of insurance is. Because that money, the money which that person has given as a premium would be paid as a claim to those 5 people. Although 1,000 people here have paid the money, but if the loss have occurred to 5 people, so it has been utilized to give claim to those 5 people. So a large number of people compensate for the loss of a few people. So this is the basic notion behind insurance. So insurance is all based on probabilities. So therefore there is a special subject which is known as actuarial science. So basically this is the brain behind the insurance. It's like a designing office. It's like an R&D of an engineering company. So the designers are the people, whereas the persons who are working in the production on the production floor, they just implement the designs given by the design department. So basically actuaries are the people who undergo these courses. So they have to work, they have to assess what would be the probability of the people dying, what would be the probability of the collisions, what will be the probability of fires occurring, what will be the probability of the theft or burglary happening. So based on those statistics, they work out a premium. Had it been, instead of 5, had it been 10, then the amount per head would have been different. Had it been 20, then it would have been different. And so, or if instead of 5, say even 10 people die, from where the rest of 2.5 lakh will come? All of them will demand 50,000 rupees each. So therefore this estimation process is very important. This is highly technical in nature. So therefore investments, yes, in life insurance, probably initially only term insurance was given to the people. But then, you know, as a human psychology, because life insurance, you cannot assess the extent of loss in 1 year. Because it depends, in life insurance, a human asset is involved, a human life is involved. So you can assess the loss condition over a period of time, say 10 years, 15 years. So minimum term has to be 5 years. So for example, a person has bought a term insurance for say 20 years. After 20 years, the person should feel happy that okay, nothing has happened to me. It's good that my family could not avail that sum assured. They could have avoided only if I had died. But rather, it's the other way around. People used to think in those days, oh, what a mistake, what a blunder I made. I invested this money. Had I invested this money in some form of bonds or in some form of other certificates, then this money would have quadrupled by this time. After 20 years, maybe I would have made 5 times of that money. So I was just frightened by the salesperson. At that point of time, I got frightened that something is going to happen to me. I'm quite hale and hearty. So in order to market our plans, so insurance companies bundled these plans with investment plans. So the person thought, even if I had put this money in bank, I would have earned so much of interest. They said, okay, we will do this thing for you. We will do those savings and investments for you. So they gave a 2-in-1 plan, savings plus insurance. So basically investment these days, now what happened? Now, because of the falling interest rates, people were not satisfied with the returns which they got from the insurance companies. So insurance companies had to sell their plans. So they said, okay, if you are ready to bear a part of the risk, we will invest it in equities, in mutual funds, in stocks, in other treasuries. So, but you'll have to bear that market risk. You have to bear. So they are bundled with those investment plans. Whereas in general insurance, everybody knows whether it's an engineering insurance, whether it's a transit insurance, whether it's a cattle insurance, crop insurance, we don't get anything. There is no investment part associated with that.
Okay, sir. Sir, what factor affects the cost of insurance?
What factors affect the cost of insurance? Okay. See, pricing is highly technical in nature, as I had told you. Actuaries basically they work on pricing of a product. Number one, as in any other product, first of all, the price should be competitive in the market. What the other competitors are offering for the same terms and conditions, for the same benefits, cost should not be too high. At the same time, neither it should be too low, and it cannot be too low because of the cutthroat competition. How you can price it as so low? Other people also work on it. They also have their technical people. So basically the factors are, number one, the actual statistics, actual loss statistics, which are available from the census, from the government, then once the insurance company is in operations for the last several years, then they have their own statistics to bank upon. They have their own past claim experience. Say now some of the companies are, some of the new private companies are 7 years old, 7, 6, 7. So they have their own statistics to bank upon. What was their claim experience in the previous years? So based on that factors, they predict for future years. Basically, it's a science wherein you predict for future years. You had also studied this kind of thing in probabilities and all when you used to study your mathematics. So it's basically application of that thing on it. All sorts of statistics, and they also try to assess what was the deviation, what was the mean deviation, what was the standard deviation, and all those concepts. So first of all is their estimation. Number two, their past claim experience. Number three, the competitors. Number four, their own expenses, administration expenses. Some companies have more expenses, some companies have less. It depends on company to company. Their own turnover. Sometimes the expenses, a lot of branch office, a lot of infrastructure is offset by the kind of sales which they are making. Sometimes the company is not able to make their sales already. They have built a huge infrastructure, but their sales are not that much. So they will have to include that kind of cost also in their pricing. Then their own solvency also matters. Basically, the main issue with an insurance company is to maintain their solvency. Solvency ratios or solvency. Solvency is basically the ability of a company to pay its liabilities. Basically, it's a liability business only. They are not manufacturing anything. There is no production house. There is no trading. It's basically a concept which are selling. It's basically a hope. Insurance is a hope which you would be given on the happening of a certain event. So you should be able to, the insurance company should have those funds in order to meet its commitments. If they're not able to meet their commitment, then they will lose all their goodwill built all over the years. So therefore, in order to maintain those solvency ratios, they have to price their product. They have to include that component also. So that if what happens if that X number of losses happens, will they be able to pay that? So they have to include that factor also in their pricing.
Thank you, sir. It was a very knowledgeable session, and we all have gained up very much. Thank you so much.
Thank you. Thank you. All this was recorded?